Hello there, Dorian Daily listeners, and welcome to the second episode of the Dorian Daily podcast. Today we're going to switch gears slightly to discuss some economic and business questions which I have prepared. I hope they will prove to be both intriguing and insightful, but before I do so, I would like to just bring up a quote. I wanted to do this in the first episode, however I forgot. So without any further ado, our first quote comes from one of my favorite economists in the history of the world, Thomas Sowell. He is a fellow at the Hoover Institute of Stanford University and completed his PhD under the guidance of another phenomenal economist by the name of Milton Friedman at University of Chicago. So the quote reads, "The first lesson of economics is scarcity. There is never enough of anything to fully satisfy all those who want it. The first lesson of politics is to disregard the first lesson of economics." I love this quote because A, it is very true, and B, perhaps sadly, it speaks to the fact that government spending on various social programs has truly become decoupled from the business cycle. At first, John Maynard Keynes, the British economist, thought that it was the role of the government in times of recession or bust periods in the economy to prime the pump and spend some money either in the form of increased social welfare programs or stimulus packages, various tax incentives. However, today, it's really become decoupled from the business cycle. So regardless of whether or not the country or the province or the state is in a boom period, bust period, a growth period, or a recessionary period, the government will very much just continue its spending patterns and maintain a certain percentage of debt to GDP in order to appease the electorate who do not like having something taken away from them once it's already been granted, which of course disregards the first lesson of economics, which Thomas Sowell says is there is never enough of everything to go around. However, especially for those who want that good. However, the government is very much in the position to say, we have enough for everybody and we'll provide it to you. And that usually comes at the expense of future generations, unfortunately. But not to espouse too much doom and gloom, it's probably a good time to switch over to the prepared questions. And the first question which we have prepared is, when is a company likely to reduce the prices of the goods and or services that it sells? This is somewhat counterintuitive insofar as usually we see the prices of goods going up. The main reasons for these are, in my opinion, twofold. One is inflationary pressures. Depending on which country you live in, I know here in Canada, inflation per year is anywhere between 1.5 to 2%, meaning the costs of inputs and the costs of goods sold generally rise with that level of inflation. I know I used to be able to get a hamburger at McDonald's for $1.39 and now it's somewhere over $2, and that's because of inflation, and it's also because of various governmental policies, specifically in the form of minimum wage. So business owners need to recuperate the cost of increases into the minimum wage somehow. And especially in the retail sector or in the restaurant or like grocery business, effects of minimum wage increases is very noticeable in the form of increased prices. It's actually another quote, 2 for 1 today. It's attributed to a professional baseball player, Sam Ewing, for the Chicago White Sox and Toronto Blue Jays. And the quote reads, "Inflation is when you pay $15 for the $10 haircut that you used to get for $5 when you actually had hair." It's pretty funny. So today we'll see not why companies raise prices, but why they would actually decrease them. So there are several reasons why companies are likely to reduce the price of the goods or services they sell. The first maybe is that the firm adopts a cost leadership strategy. This is quintessential in Walmart, for instance. Cost leadership strategy occurs when a firm seeks to provide a good or service for cheaper than anybody else. This is why at Walmart you see price match guarantee. Being a cost leader is necessary if one operates particularly in a commodity industry such as steel or generic drugs, or to some consumers air travel, whereby all the firms produce an identical, undifferentiated product. Insofar as firms in these types of perfectly competitive environments are price takers, and especially in the commodity industry, they cannot charge above and beyond what other suppliers are selling for, and must reduce their prices if that is what competitors are doing in response to market demand. Because the buyers of these goods do not, a banana is a banana, they don't care where it's from as long as it's yellow, looks like a banana, and tastes like a banana. And is perhaps fresh. The second reason why a firm would drop the prices of the goods or services it sells is that the firm is intentionally adopting a price skimming strategy. So a price skimming strategy is one whereby a firm charges the highest initial price that customers are willing to pay, and then continues to lower it over time. This type of strategy is especially viable amongst products in the introduction phase of the product life cycle. So as you may not know, product life cycle is generally, introduction, growth, maturity, or the cash cow phase, and then the decline. And there's maybe we'll do an episode later as far as business strategies with respect to each stage of the product life cycle. But putting that aside, the early stages of the product life cycle in which it's viable to adopt a price skimming strategy is when there's not too much competition and room for profits, or for high profit margins is especially available. So there's only one supplier of a good and everyone wants that good, and there's not that much competition. Maybe various innovative electronic products such as the Apple iPhone, or maybe even like the PlayStation 3. As soon as the iPhone came out, first graphical user interface, everybody wanted it, and they could command prices of $1,000 plus. And now generally get them free with contracts from cellular providers. Or the Sony PlayStation, I think when the third generation of the console came out, it initially sold for $600 because it's a new entertainment console. Everybody wants their hands on it. And now plenty available. There's a plethora of stores selling old PlayStation 3s or the third generation ones. Went from $600 initially to below $200 when they put them on sale. So that's an example of a price skimming strategy. Third reason by which a business or a firm would drop the price of their goods is if there's price competition amongst existing players in the industry. It's actually illegal in many countries, especially the United States and Canada, for firms in the same industry to collude on price or to fix the price at some agreed upon level. This is a lesson that was learned by Air Canada when they were charged by the European Union alongside 10 other airlines in a price fixing scheme for international cargo shipments. But while it is illegal to fix prices, it is not illegal for firms to charge whatever price they want and to change their price in response to the price decisions of other firms or businesses in the same operating environment. The degree to which this happens depends on firm price elasticity. Not to get overly economic or technical on everyone here, but firm price elasticity depends on both the market price elasticity and the closeness of competitors' products. So elasticity in its most general or basic sense is how do consumers and how do businesses respond or change their consumption patterns in response to changes in the price of a good. Perfectly elastic good would be one where the price changes by X amount and people's demand for that good changes by X amount, the exact same. Whereas an inelastic good, an example would be like gasoline, where the price is going to have to go up really high before customers change their consumption patterns or change how much money they spend, or change how much gasoline they consume because they don't have any alternative. An example of firm price elasticity would be if Microsoft drops the price of their Xbox by 10% without Sony decreasing the price of their PlayStation. Microsoft will gain sales relative to the more expensive product, and Sony will have to decide whether to reduce their price in line with that of Microsoft's Xbox accordingly. The extent to which competing on price is a good strategy depends on the firm size, the market price elasticities, and the nature of the product, amongst other things. There's a lot of really great literature that you can find. Maybe I'll put it in the show notes, or I will put it in the show notes on firm price elasticity in the automobile market, particularly when like General Motors was the dominant player in the latter half of the 20th century. So they would very much punish any of the other auto manufacturers such as Chrysler or Ford that tried to reduce the price of their cars, because being the larger behemoth that they were, General Motors can afford to reduce their price even cheaper than one of their competitors and keep it going until the competitor would eventually go bankrupt or run out of business. So it was not a good idea to compete with General Motors on price of the vehicle. Another example would be, or an example really, would be Coca-Cola and Pepsi. They compete on marketing, despise each other, but wouldn't be able to live without each other insofar as they actually gain sales from each other's marketing. A classic example was the Pepsi Taste Challenge, where people did blind tests of Pepsi versus Coke and said which one they liked better, and turned out people liked Pepsi better, and the anecdotal number of surveyors or people who conducted the survey that participated. However, after the marketing campaign, both Pepsi's and Coca-Cola sales went up, so that was quite interesting. And you'll see the prices of bottles of Coke, cans of Pepsi, they remain identical. They never compete on price, they only compete on marketing. So that's interesting, I think. Another reason by which a firm would drop the price of a good is that they have better supply chain management, and this allows for price reductions downstream of the supply chain, which at the bottom of the supply chain is the end consumer. So the more efficient the firm's supply chain, the more value that is created, that is potentially passed on to consumers in the form of lower prices. The quintessential example of this type of approach is Walmart, who consistently puts pressure on suppliers to lower prices. While the firm adopts a low price strategy, they are not necessarily a low cost provider, such as a no frills or a discount grocery store. Like Walmart invests heavily in optimizing their supply chain and integrating it with their suppliers in order to provide the lowest possible price to consumers. And this is by no means cheap. So I think it was in the 80s, they had their own satellite system, which is just like, it was insane. At that point in time, no retailer had their own satellite system. Like literally, they had a satellite in space and had it connected to all the stores and knew exactly where the products were going at which time on any given day. It was truly remarkable. And all of this was to optimize the supply chain in order to have efficient movement of goods and pass on that efficient movement to customers in the form of decreased prices by virtue of not having things wasted or spoiled or broken or misplaced, and knowing exactly to send the goods where they would get off the shelves quick and product would be moving. A fifth reason by which a company would drop the price of its good is that they realize economies of scale and learning curve effects. So firms may be able to reduce prices when they fully realize economies of scale, which essentially just means that the more goods they produce, the cheaper per unit it becomes to produce said good, insofar as the fixed costs, or the costs that do not change for the firm, remain the same, and then they get shared over more and more goods, while the variable costs will remain the same. It becomes cheaper per unit to produce the more that good is being produced. With respect to learning curve effects, this is especially true for manufactured goods. So as workers become more and more specialized at making certain products, they become more efficient and increase their output capacity. Just think at your own workplace where first or second week you started off, you might have been slow or you didn't know exactly how to do a task, and now after all your experience, it takes you 2 seconds to complete the task. So this is a learning curve effect. The increase in efficiency ultimately results in cost savings, be it more time or more time available to do other things and more goods produced. And this can be transferred to consumers in the form of lower prices. The sixth major reason by which consumers would experience or benefit from a price decrease would be costs of inputs and change in technology. So cheaper input costs, we discussed earlier about more expensive input costs in the forms of minimum wage, but cheaper input costs and or technological improvements also enable firms to reduce the price of their goods in order to increase overall demand and possibly revenue as a result of subsequent income and price effects. I guess as an aside, we probably should have started talking about a basic demand-supply model, which I don't want to bore everyone or put them to sleep more so than they already are. But generally speaking, on the demand side, cheaper a good is, the more it's demanded, unless it's like a inferior good. And if it's a luxury good, the more expensive it is, it might actually be more sought after if you think of like a Rolls Royce or a Louis Vuitton bag. But anyway, so with respect to the cost of inputs, the decrease in price increases real incomes, meaning that people are relatively richer than they were previously because they can afford more of that good, given the price decrease. And this leads also to more demand for the good. With respect to the change in technology, the price effect leads to substitution of the lower priced product in place of the relatively higher priced product. The firm is able to lower the price because there's some technological advancement, such as through manufacturing process or better digital capability or software that enables them to produce more goods for cheaper. It is important to note that while some firms have the capacity to reduce price, i.e. they have excess profit margins, they will not always choose to do so for several reasons. A classic example is a luxury goods producer, such as like Louis Vuitton or Rolex. They don't want to decrease the price of their good too much by virtue of the fact that it might associate the decrease in price with the decrease in quality, and that's not what they want at the luxury goods market. So I think that's it for reasons why businesses or firms decrease the price of their goods. If you can think of anything else, please feel free to reach out to me. As sadly, I think it's mostly price increases in the form of inflation or increased input costs or increase in minimum wage, taxes, things along these lines. So if you do find decreases in price, like obviously big sales too, but sales is just to stimulate the demand side because there wasn't enough at the retail price or face value price, so they needed to decrease the cost of the goods in order to actually sell them. So I guess in some roundabout way, that is one reason why firms decrease the price of their goods, is because they were priced too high and they needed to decrease the price in order to sell the product. Without any further ado, I think maybe we'll move on to the second question. And the second question is actually sort of a criticism, like a critical response to a book entitled Reimagining Capitalism. It was written by a senior partner at McKinsey consulting firm, as well as dean of the school in which I obtained my MBA from, the Schulich School of Business. The basic or underlying thesis of the book is that companies should use a long-term horizon, at least 10 years, when they make strategic decisions about the direction of the company. And the response is, why haven't companies done this yet? It's because the authors of the book propose that companies need to evolve from a narrowly defined shareholder capitalism, whereby they focus on quarterly results and quarterly earnings and try to appease the short-term investors in the company, like in as much as possible. And they need to transition from this to focus on long-term value creation and the prioritization of a broader set of stakeholders. So not just the shareholders or the people who own equity in the company, but rather, the stakeholders such as like employees, the environment, like the community, like future generations, various other people that are involved in the business, not necessarily from an ownership perspective. So in theory, it's a great idea. I would be very much happy to build strong, lasting institutions and companies for future generations. But the reality of the situation is that in practice, having a long-term perspective, particularly in corporate America, does not work and will likely not be implemented by companies in the near future for several reasons. The first reason is that executive compensation is misaligned with the aim. So as it stands, there's a reason that companies are fixated on quarterly results and annual financial reporting. And it's that the executive compensation, so the people in the C-suite, the CEO, CFO, COO, Chief Operating Officer, they're tied to short-term performance of the company. A good example is in Cineplex, which is like the premier place for Canadians to go watch movies. The CEO of Cineplex, who actually is a alumni of my school at Schulich MBA, his compensation is derived in part by an adjusted EBITDA, which is earnings before interest, tax, depreciation, and amortization, and which in turn affects the common share price of the company, whereby like the share price is calculated by earnings per share at time t divided by a weighted average cost of capital plus the present value of expected growth opportunities. Not that you need to know that, it's like super technical, but in the scenario, which is like that of other firms, the chief executive officer is incentivized to make money now, not in the future or 10 years from now, but at the present, like in the next quarter. If their stock options are to be worth anything, then the common share price needs to be higher than what it was listed at in the options package that they received when they initially took on employment as the CEO. So the reason for the approach, or this alignment of interests, is to try and avoid agency problems between the CEO/executive and the company's shareholders. Like for the shareholders' part, they're concerned with one thing, which is the financial performance of the company relative to other firms that they could have invested in. And their measurement of performance is thus backward looking. So it's how has this company performed versus other companies? And this begs the question from shareholders is, what has the CEO done for me lately? The idea that shareholders will do a complete 180 and compensate executives for future performance is sort of preposterous. It's essentially you sink or you swim. You either perform financially, like as the CEO, the company performs financially well when you're at the helm, or they don't perform financially well relative to other companies that shareholders could have invested in, and they will promptly ask for your dismissal at the next board meeting if you're not meeting their expectations. So unfortunately, it's corporate America. It's very cutthroat, and it's a mentality whereby you need to make money in the short term now, and there's not that much long-termism as far as that's concerned. The second reason why long-termism for private businesses and corporate America is not necessarily viable at this point in time is that corporate governance is also not structured in such a way as to incentivize it. The globalized world in which we live allows for the instantaneous movement of capital and high-volume stock trading daily. Most investors, including many institutional investors such as the big banks and hedge funds, they rarely have a long-term horizon for any particular investment. What this means is that ownership of publicly traded companies changes in an instant. The largest shareholder voting on crucial decisions at any given board meeting could easily vote and sell off their ownership position the next day. The long term for these groups of investors is irrelevant. They just want to maximize the value of their investments at any given point in time and then leave strategically or at a strategic point in time. Interestingly, countries such as France have taken the approach of the authors of Reimagining Capitalism and tried to counteract the short-term behavior by giving double voting rights to shareholders that have held the common shares for at least 2 years. However, even if you hold your shares for 2 years, it doesn't outweigh the financial incentives of the firm to maximize short-term shareholder value above all else. And maybe I'll say as an aside about short-term stock trading is that you're never going to beat the market. At any given stock exchange in the world, be it Toronto or New York or London or Tokyo and Shanghai, there's armies of analysts and financial types, investment bankers that are active in the market as their full-time job, just day in and day out, analyzing everything, short selling, taking long positions. The best thing, as per Warren Buffett, who's one of the greatest investors of all time, he believes that the ideal holding period is infinity. So don't try and time the market. Don't try and just buy or sell stocks based on whims and the ticker or whether it goes up or down. Try and try and find companies that you believe have a long-term, future, that have been around for a long time, that they're blue chip, they've maintained consistent dividends and revenue growth. I'll definitely do an episode in the future on valuing companies for stocks. Not that I wouldn't recommend it. I think that you'd be just as well investing in exchange traded funds and letting Vanguard or BlackRock do the day trading for you. But just as an aside, the Warren Buffett approach is that the ideal holding period is forever, and that you should never try and time the market, which unfortunately the institutional investors such as the hedge funds and the banks, that's exactly what they're doing day in and day out. And this is what makes short-term, make money now pervasive in corporate America, as opposed to taking like a long-term perspective for the business. The third reason by which companies will not take a long-term perspective is that people are inherently self-interested, and they will not rely on future leaders to execute their strategies. You may prefer the old adage, if you want something done right, do it yourself. So they're not going to trust people in the future to execute the game plan. And the availability of superstar executives is very scarce. As such, like the longevity of chief executive officers and like chief financial officers and other C-suite executives at any respective firm is very short-lived. It's similar, you see this in like the NBA, whereby superstars like LeBron James and individuals like of his caliber, they test free agency every few years and just jump to the highest paying ship. They don't do like the long-term contract. So to retain their value, executives at companies need to rely on past performance, much like athletes, and like a proven track record. They cannot tell prospective employers that, I left the company with a great strategy to be executed over the next 10 years. Boards want to know, that you can and will execute now, not in the future. The fourth reason by which long-termism will not exist in corporate America is that the short-term mindset is really pervasive amongst not just the business world, but in life in general. I mean, you think personally, or like the micro level, or even in in the public sphere, like it's very short-sighted. It's either the next election cycle, or maybe personally, it's like, what am I going to do today? People don't think about what's going to happen in like a decade or 2 decades from now, especially when you're young, maybe. So, yeah, short-termism is not a uniquely business phenomena. It proliferates all aspects of economic life at the individual level and at the public sector level. It's evidenced by the fact, especially at the public level, that governments are persistently willing to carry enormous budget deficits in order to buy the votes of existing voters. Their vision is only so far as like the next election. Someone somewhere down the line has to pick up the bill and all the government spending, and it's ultimately like the children and grandchildren of the people in power, but they're just too short-sighted to realize that. Anyway, not to get too back to the doom and gloom again, but trying to espouse some truth here at Dorian Daily. I don't want to beat around the bush or be overly optimistic. I mean, try to have some realism and some rationalism and say that, this is the way the world works. I think it's a great time to be alive, and it's definitely the best time in the history of the world to be alive is the 21st century. But with that said, it's not perfect, and we can try and understand the shortcomings and deal with them accordingly. So that maybe brings us to our third question on a somewhat later note, it's speaking to interest rates, and specifically, proponents of a modern monetary theory argue that investment spending is not impacted by interest rates, be it at like the personal level or the firm level. That is, like, investment spending has a zero interest rate elasticity. So we talked about the concept of elasticity previously, whereby changes in prices change people's consumption patterns. So what the proponents of modern monetary theory argue is that the changes in the interest rate, right now prime in Canada is about like 3.95%. They're saying, like, if it jumped up like tomorrow, people wouldn't care. They would keep their consumption patterns the same. I personally disagree with modern monetary theory that investment spending is insensitive to interest rates. Insofar as the notion, has been largely propagated, in my opinion, by the prolonged and the historically low interest rates that we have experienced in North America. In the 1980s, for instance, people were paying interest rates like in excess of like 20%. It was insane. And now, like, below 5%, like they were even like 1-2% at a certain point in time. Maybe we'll do a more in-depth discussion on interest rates, but for now, we'll just suffice to talk about like the elasticity of interest rates on spending patterns. So, despite the reality of having short or very relatively historically low interest rates in the 21st century, especially the second decade of the 21st century, I believe that investment spending at both an individual and firm level will remain negatively correlated to future interest rate changes, especially increases, What that means is that the more interest rates increase, the less people will assume debt in order to spend on things. So why do I think this? I think for two reasons. One is that the effect of interest rates on aggregate demand, it's still negatively correlated. So consumer spending on like durable goods, such as like cars, as well as investment spending at the firm level, it increases when interest rates decrease, and it decreases when interest rates increase. On the investment spending side, this is readily apparent in the demand for residential housing. So the more money that it costs individuals to obtain a mortgage, that is, like the higher the mortgage rate, the less total principal that they will be willing to take on or be able to afford over a maximum 25-year amortization schedule in Canada. So while some individuals may only be concerned with the dollar amount or the monthly payments and not the amount of interest they are paying to the bank, there's likely going to be a reality check for many of these people when they're no longer able to finance the cost of their borrowing if and when mortgages approach 10%. Like the same holds true for durable goods. The low interest rate environment has afforded many people the luxury, of driving very fancy imported cars at like unbelievably low monthly rates. But the only reason that they're able to sustain this level of spending is because interest rates have been like historically low. And then even companies have in turn, increased the amortization schedule of the loans that they're taking on. Like for instance, like if you had interest rates at 10% and the term was 2 years for like a car purchase, there would only be a certain type of car you can buy. Like you'd probably cap out at like given your spending, your available spending money, you'd only be able to get like say a Toyota or Honda or something. Like great vehicles, don't get me wrong, but like that's the level that you'd be able to buy it at. Whereas now, if you can say it's 3% APR and you can space it out over like a 4-year term, the same person who can only afford a Honda or a Toyota with the 2-year term and 10% interest rates APR can now over a 4-year term and 3% interest rate can afford like a Mercedes or like a Porsche or something. So again, there's a reality check for these types of individuals that only care about the monthly payment and not like the total amount of interest that they're paying to the financier or like the bank or the mortgagee, like what have you, is that when interest rates rise, they're not going to be able to afford the monthly payment and bye-bye nice car. But to the extent that they increase, we will expect the consumers to decrease their investment spending, on houses and cars accordingly. The second reason that I disagree with modern monetary theory's preposition is that the effect of interest rates on business investment spending is also maybe less so than on the micro side, but still negatively correlated. A 2014 survey of CFOs conducted by the Federal Reserve in the United States suggested that, contrary to investment theory and the traditional theory of monetary policy transmission, that firms' investment expenditures are largely insensitive to interest rate increases. The most cited reason for interest rate changes not affecting or delaying investment projects was, again, the historically low interest rates and ample cash reserves of these companies, in part, made into reality by virtue of the low cost of spending which these companies have enjoyed in the past decade. Once again, I believe that these reasons are historical anomalies, and I do not disprove, and I do not think they disprove the general economic principle that investment spending is inversely related to interest rates. While companies such as Apple Incorporated may have sufficient cash reserves to finance major investment projects internally, or if you're Facebook, you have sufficient cash reserves to pay out $5 billion fines from the SEC. For many firms, especially smaller firms, internal financing for all capital investment projects is not plausible as it is for the Apples and the Facebooks of the world. As a result, the small and medium-sized enterprises which proliferate, especially in the North American economy, are concerned with the weighted average cost of capital, or WACC, like WACC, of which interest rates are a factor to the extent that they affect the risk-free rate of return. And again, that's getting more technical on the finance side. Maybe I'll do a video if the listeners are interested in weighted average cost of capital, risk-free return, and various like capital investment decisions faced by businesses. But like as it stands, cost of capital increases. As the cost of capital increases, companies will be more hesitant, at the very least, more scrutinous of their capital investment decisions, as there will be more of their own future earnings, in the form of future interest at stake. While it is true that these capital investment decisions are an integral component of the firm's strategy and must be made at some point in time if the firm is to survive, firms will have decreased proclivity to borrow in the short term and instead wait for more internal cash flows to arrive in order to finance their investment decisions. Such is why I think that interest rates remain negatively correlated with spending, contrary to the proponents of modern monetary theory believing that it is not related. So I think that's it for today. I hope you enjoyed the conversation, and I hope you learned something about the economic and business environment. Sorry if it got a little bit technical towards the end there. I'm still trying to gauge the audience for Dorian Daily, and to see whether people would like a more like academic incited discussion, or I'll probably gear it more once we get some guests on the podcast just to a more basic or like a general conversation, as opposed to getting like too technical and just like lecturing. But in the meantime, I hope everyone has a great weekend. It's Friday as I'm recording this, or Saturday as I'm recording this. And I hope you enjoy the weekend, and then you have a great time relaxing and doing whatever it is that you like to do. Maybe going out and buying some cars while interest rates remain low, because the Bank of Canada is going to be increasing them very soon. Thanks again, everyone. Take care.